Hey guys, welcome back to another video. My name is Josh and today we'll be taking a look at the Harmoney IPO. Firstly, I'll go through an overview of what Harmoney does as well as discuss the terms of the IPO. Secondly, we'll take a look at the industry that Harmoney operates in as well as some of its competitors. Thirdly, we'll take a look at Harmoney's business model and how they make money. Fourthly, we'll discuss some of the risks involved with Harmoney. And lastly, we'll take a look at the valuation and then I'll share with you what I'm gonna do. If you enjoyed today's video, be sure to hit like and subscribe. If you think someone would benefit from the information of this video, be sure to pass this video on to them as well. Remember, this is not financial advice, purely for entertainment purposes only. I'm not providing any recommendation or opinion to buy this stock into these IPOs. So if you need help with interpreting the IPO and understanding whether you should participate, be sure to seek out a financial advisor. You can read the full disclaimer down below, but with that out of the way, let's go right into the video. Harmoney is an online direct personal lender that operates across Australia and New Zealand, and their purpose is to help people achieve their goals through financial products that are fair, friendly, and simple to use. They provide customers with unsecured personal loans for all kinds of purposes, such as debt consolidation, paying for education, car loans, home renovation, and so on. They operate 100% online and are competitively priced using risk-adjusted interest rates through their proprietary platform, Stellar. Interest rates range from 6.99% to 24.69%. The company originated its first loan in August 2014 and since then has grown its total loan book to 480 million. In April 2020, Harmoney shut down its retail peer-to-peer platform in order to shift from the peer-to-peer funding model towards the warehousing funding model, which I'll touch on a little bit later. Personally, I have used Harmoney as a lender and I had a really good experience on their peer-to-peer platform, which provided returns north of 16% annually over 4 years. So it was unfortunate that they shut down the peer-to-peer lending platform. If you want to know what it was like as a Harmoney lender, be sure to check out my video in the link above. In terms of the IPO, Harmoney is raising a total of 92.5 million AUD, of which 22.5 million AUD is from the sale of existing shares, which the proceeds will be used for the dominant purpose of enabling selling shareholders to cover their income tax obligations. The remaining 70 million will be from the proceeds of new shares issued, and this 70 million will be used to fund investment into the core business and pursue growth strategies, as well as to cover the costs of the offer. In terms of the industry, Harmoney operates in the personal lending segment of the consumer credit sector, which forms part of the Australian and New Zealand financial services industry. Harmoney competes against three types of lenders. So the first category is bank lender. These are your typical banks such as ANZ, Westpac, CBA, ASB, and NAB BNZ. The second category is your non-bank lender category, and within this category there are two subsets. So the first subset is your traditional non-bank lender, and these traditional non-bank lenders typically provide loans to a broader range of borrowers than bank lenders, including borrowers who may have lower credit scores. So you might think this of the people who can't get a loan from here, go to here. Examples of this include Merit Finance, which is owned by Heartland Bank in New Zealand, Avanti Finance, Flexi Group, Latitude Financial Services, and Liberty Financial. The second subset is your technology-driven non-bank lenders. These are non-bank lenders which utilize technology in the provision of their credit products to address the financing needs of customers. Competitors in this category includes peer-to-peer lenders such as Squirrel Money, as well as buy now, pay later providers such as Zip and Afterpay. So here we can see New Zealand personal lending volumes market share, and we can see that non-bank lenders on the right hand side has actually increased over time. So their market share has increased from roughly 31% in January 2014 to roughly 35% in July 2020. And likewise, you can see bank lenders have dropped their market share from roughly 69% to around 65%. Likewise, we see the same thing happening in Australia. In Australia, the growth of non-bank lenders have been staggering, increasing from 9.2% market share in May 2015 to just under 46.9% in November 2018. So data beyond 2018 is not available. However, Harmoney believes that the market share would not have reversed based on industry observations. In terms of distribution and scalability, Harmoney believes that they have the furthest distribution as well as the highest scalability because they are a 100% online business with a direct customer business model. It is no question that over time, the bank lenders and the other traditional non-bank lenders will start utilizing technology to improve their distribution and lower costs. Harmoney will need to continue to innovate to maintain their position. In terms of industry regulation, Harmoney is a finance company after all, and therefore they will always be heavily scrutinized by the regulators. Harmoney does operate in both New Zealand and Australia, therefore laws in those two countries will apply. These are some of the legal requirements that Harmoney needs to meet in New Zealand, but I won't go through them in this video, otherwise this video will be way too long. But from this, what we can gather is that there might be a little bit of a barrier to entry for new players that are looking to enter into this industry. Next, let's talk about the business model. So Harmoney generates its income by charging its customers interest and fees for the provision of its loans. So Harmoney uses a variety of digital marketing channels such as comparison websites, display advertising, social media, as well as online video platforms to attract new customers. What's interesting is that 35% of their originated loans came from Google Ads. Now this is how it works. Harmoney provides a generalized target profile based on customer lifetime value from their Stellar platform. And Google matches this profile with its users across its ecosystem. And when it matches the profile to an audience, Google will show them targeted ads. What this does is that it ensures applicants are likely to meet Harmoney's credit criteria. And on the flip side as well, Google excludes advertising to applicants that are unlikely to meet Harmoney's criteria. And what this does is that it causes a feedback loop to improve results on the Stellar platform. Now let's talk about the sources of funding. There are two different sources of funding that Harmoney utilizes, and the key costs between these types of funding differ. So the first one is the peer-to-peer funding model, which is expected to phase out in the next 12 to 18 months. The costs involved in this model are the sales and marketing costs, as well as the support costs. So in a peer-to-peer funding model, Harmoney operates as an intermediary to match a lender as well as a borrower. And Harmoney only collects a fee from the lender and a fee from the borrower. It doesn't assume credit risk. However, with a warehouse funding model or a warehouse facility is essentially a debt facility that Harmoney can draw on to lend to loan applicants. In this case, Harmoney becomes the lender to the loan applicant, and as such, Harmoney takes credit risk. Therefore, Harmoney incurs borrowing costs and loan impairment costs compared to the peer-to-peer funding, which doesn't have these two costs. And the reason why Harmoney is phasing out the peer-to-peer funding model within the next 12 to 18 months is because the warehouse funding model is cheaper and therefore more profitable for Harmoney. Here is a table of the average funding rate or the cost of funds. As you can see here, the average funding rate for the peer-to-peer funded loan book is around 7 to 8%. However, if you look at the average funding rate for the warehouse funded loan book, the interest rate is much lower at roughly 4.4 to 4.7%. And you can see as well that Harmoney is slowly moving away from the peer-to-peer funded loan book. As you can see here, the percentage of the loan book funded by peer-to-peer decreasing over the years. And currently the peer-to-peer loan book is roughly 67.6%. What I found interesting as well is that overall, Harmoney has a crazy high net interest margin of around 10%, as you can see here. The net interest margin is the difference between net interest income and the interest paid out to their lenders. So essentially that is the average interest rate minus the average funding rate equals your net interest margin. To give you some perspective, the traditional Big Four banks have net interest margins of roughly 2%. The reason why Harmoney has such a high net interest margin is because they provide unsecured personal loans, which tend to carry higher risk than secured loans. So figure 2 here from the prospectus summarizes key financial drivers of Harmoney's profitability. Harmoney's strategy is to increase their loan book with the proceeds of the IPO by growing the Australian business. Furthermore, they plan to increase their net interest margin by decreasing the funding rate by moving towards the warehouse funding facilities. Furthermore, with the use of their Stellar platform, they're able to reduce operating costs and also reduce impairment expenses by finding better quality loans. And if you do the maths, what this means is that your net profit overall would increase. And that is the strategy of management to increase the profitability of Harmoney. So the next section that I'll talk about are the risks involved with Harmoney. There are 3 key risks that I think impact Harmoney the most. So the first one is credit risk. Harmoney's ability to manage credit risk will depend on their capability to price credit risk. If they don't price it correctly, then this will reduce profitability. Secondly, it depends on Harmoney's ability to scale. Harmoney is a relatively small business compared to traditional banks, and profitability is dependent on its ability to scale its Australian business. While Harmoney has been successful in achieving a market-leading position in New Zealand in a short time frame, this is no guarantee that they will do so the same in Australia. And lastly, there is a risk of non-compliance with regulation. The financial industry is heavily scrutinized by the regulator, and Harmoney actually has been previously fined before back in 2016, where they were found to be misleading consumers. As well as that, it is very common that industry players in the financial industry get fined by industry regulators. All you need to do is search up Google and you can see a whole heap of fines from ASIC. So there is a high risk with regulation in the finance industry, and Harmoney is susceptible to those risks. However, I think the strength of the management team will help mitigate some of the risks involved. David Stevens is their CEO and Managing Director. David is a highly experienced Chief Executive Officer specializing in the non-bank consumer and commercial finance sectors within Australia and New Zealand. Prior to this, David served as CEO and CFO of Flexi Group, a diversified financial services company focusing on commercial and consumer finance in Australia and New Zealand. And as previously mentioned, Flexi Group is one of the competitors of Harmoney. And the founder as well is also the Chief Product Officer. He also used to work at Flexi Group as Head of Sales and Business Development. As well as that, Neil has been involved with the business since founding Harmoney over 6 years ago. So based on the experience of management, I think management is in a good position to help mitigate some of the risks involved with Harmoney. So the next part of this video is the financials and valuation part of Harmoney. So here we have the key operating and financial metrics of Harmoney. So Harmoney has a 30th of June balance date. And so this will be for the year ending 30th June 2020, and these numbers here are essentially the 4 months to October 19 and October 20, and this number is a forecast, as I believe when they were preparing the prospectus that wasn't the end of October yet. What's interesting here is that you can see originations have actually decreased from FY19 to FY20, decreased roughly 15 million to 420 million. And the reason being is that during the Rona, Harmoney changed their credit risk and underwriting policies, including seizing funding of higher risk grades, raising credit score cutoffs, reducing credit limits, and stopped lending to customers employed in high-risk industries such as tourism. So I think that was a good move from management to mitigate some of the credit risk increasing during the depths of the market crash. And you can see that the increase in credit risk did involve an increase in impairment expenses from $17.3 million to $24.3 million in FY20. Moving on to the income statement, we can see that revenue has increased 25% in FY19 to 74.1 million, and then increased another 16% to 86 million in FY20. However, if you look at the 4 months since their balance date, to October 2020, you can see their total income has actually dropped 9% compared to the previous year's 4 months. If you look at net profit after tax, it's actually improved from $708,000 of loss in 2019 to $1.247 million in 2020. And the reason for that is because of the change in the movement of expected credit loss provision. So I dug deeper into note 5, as mentioned here, to see what this meant. And what I found was that the movement in expected credit loss provision represents the non-cash movement in the expected credit loss provision from the end of the prior period to the end of the current period. In other words, what they did was they had a provision that X number of loans will default. However, because the loan book has decreased, they have released some of the provision, and hence why a reversal in the expected credit loss provision. And what this meant was that there was an increase in net profit after tax. And what you need to remember as well is that this movement in the provision is a non-cash item. So in order to remove the impact of this, we'll take a look at the cash net profit after tax. And what we can see here is that the cash net profit after tax has increased by 64% to $1.086 million in the 4 months to October 2020. Now, moving on to the valuation, assuming that they have a market capitalization of 353.2 million AUD according to the prospectus, and if we extrapolate the 4 months to October 20 forecast cash net profit after tax to a year, we get $3.258 million. And what this gives us is a PE ratio of 108 times. So this is a relatively high PE ratio. What this means is that you're putting in $108 today to get $1 of return back. If we look at the book value, they have a book value of 75.285 million Aussie dollars, which gives us a price to book ratio of 4.69 times. Now, this is quite a high price to book multiple if this is a pure play banking stock. So from the looks of it, they are trying to sell themselves as a technology company, and the valuation certainly seems that way. So overall, I think Harmoney has several key strengths in terms of their business model. So firstly, they're able to offer risk-based pricing for their loans. Secondly, they're able to fund accounts within 24 hours. And thirdly, they have a simple automated online process where customers can just go on their website to apply for a loan. Furthermore, the company has shown that it has taken preventive steps to reduce bad debt during the Rona situation, which shows that management is able to manage risk well. I think the management team is really good as well in the sense that they have a lot of experience within this sector. However, I think the timing of this IPO is a little bit unfortunate because there's so much uncertainty in the market, and I don't think we've seen the full impact of the Rona on the economy yet. And given that Harmoney does operate in unsecured loans, those are the loans that will get hit first if we fall into a deeper recession. However, I must say that I am happy with my holdings in Harmoney indirectly through my ownership in Heartland Group Holdings, who own roughly 8.4% of the shares on issue on completion of the offer. So for that reason, I'm not investing in this company yet. So I'll take a wait and see approach and maybe invest in the future when things become more certain. For now, I am happy with supporting Harmoney indirectly through my shares in Heartland Group Holdings and be part of Harmoney's purpose of helping people achieve their goals through financial products that are fair, friendly, and simple to use. All right, so I hope you enjoyed this video. Let me know down below if you're investing in the Harmoney IPO, and share this video with someone who you think will find this helpful. I hope you enjoyed this video, and as always, this is not financial advice. And thank you for watching. Until next time, take care.